Welcome to Flippening, the first and original podcast for full-time, professional, and institutional crypto investors. I'm your host, Clay Collins. Each week we discuss the cryptocurrency economy, new investment strategies for maximizing returns, and stories from the front lines of financial disruption. Go to flippening.com to join our newsletter for cryptocurrency investors and find out just why this podcast is called Flippening.
Clay Collins is the CEO of Nomics. All opinions expressed by Clay and podcast guests are solely their own opinion and do not reflect the opinion of Nomics or any other company. This podcast is for informational and entertainment purposes only and should not be relied upon as the basis for investment decisions.
Hi, this is Mike, producer of the Flippening podcast. I'd like to welcome you to this conversation between Clay Collins and Philip Gradwell. Philip is chief economist at Chainalysis, a provider of blockchain intelligence and compliance solutions for businesses and law enforcement. After touching on Philip's background, Clay and Philip discussed the new report from Chainalysis entitled A Big Look at Bitcoin. I should note that this report includes economic data and analysis that's never been revealed before. Focused on the report, Clay and Philip discuss a range of topics including how Bitcoin is being used and spent, how much BTC is lost forever, the true scale of illicit activity occurring on the network, and finally, the role of exchanges. The conversation is split into 3 chapters. Chapter 1 considers how Bitcoin is held, traded, and spent. Chapter 2 examines the link between Bitcoin and crime. Chapter 3 is a deep dive on exchanges. Transcript and show notes for this episode are available at flippening.com/Philip. That's flippening.com/PHILIP. And now before we get started, here's Clay with a word from our friends and sponsors.
This episode is brought to you by a really cool product that I personally love and endorse called Uphold. I use Uphold every day, so I'm reading you my ad, not theirs. So here are 6 things that I think you should know about Uphold. First, if you're using the Brave browser, you've probably already been using Uphold every day as it's their default wallet for holding your earned BAT tokens. Second, Uphold lets you hold and trade between crypto assets, national currencies, metals, and more in just one easy step. In fact, you can instantly swap between 27 fiat currencies, 30 cryptocurrencies and utility tokens, 6 stablecoins, and 4 metals, all from your very own wallet. Need to go from gold to Bitcoin in one trade? That's no problem. Want to send BAT to your Euro bank account? That's also no problem. Third, Uphold has 0 trading commissions and 0 bank and crypto withdrawal fees. Fourth, Uphold lets you buy cryptocurrencies directly with a credit or debit card, allowing you to lock in prices sooner than your ACH transfer can process. Fifth, Uphold allows for direct bank connectivity in almost 40 countries using ACH, SEPA, and SWIFT. Uphold recently added countries including the UK, Canada, Poland, the Czech Republic, Romania, Hungary, and Croatia. And of course, they already support the United States and USD. Sixth, and finally, you can open an account in 1 minute and start trading in 10 seconds. We're big fans of Uphold here, and as a product person, I think what they've done and what they've made seamless is really incredible. So I encourage you to try them out. To get started, just go to uphold.com today. Again, that's uphold.com. You can also download Uphold from any app store. This episode is also brought to you by the good folks at Nexo.io. Here's a word from them. Nexo is the only lender offering instant crypto credit lines, which let you use digital assets as collateral to get cash in 45 fiat currencies and stablecoins. You might remember Nexo from episode 64, where we spoke with their co-founder, Antony Trenchev. If you haven't heard it, I highly recommend checking them out as it's one of our most popular episodes to date. And Nexo has a big announcement related to credit lines. Their annual interest rates for credit lines are now starting at just 5.9%, which may very well be the lowest borrowing rate in the entire industry. Nexo is also a strategic partner of exchanges, OTC desks, and crypto funds through its portfolio of structured financial products. Institutional counterparties can earn up to 8% annually on their idle stablecoins, enter into asset swap agreements, or directly borrow crypto. Individuals can also park their cash and stablecoins at Nexo's interest-earning account to get an annual return of 8%. What's more, interest is paid out daily, and you can add or withdraw funds at literally any time. So if you're looking to borrow, lend, or swap digital assets, Nexo is your go-to partner. Definitely explore Nexo.io, and if you're an institution, reach out to them at institutions@nexo.io. Finally, this episode is brought to you by the Nomics API and CSV data export service. If you need an enterprise-grade crypto market data API for your fund, smart contract, or app, or if you need historical CSV dumps of trading data or crypto market cap data from top exchanges or even obscure ones, then consider trying out the Nomics API or our historical data export service. Our cryptocurrency API enables programmatic access to clean, normalized, and gapless primary source trade data across a number of cryptocurrency exchanges. Instead of having to integrate with multiple exchange APIs of varying quality, you can get everything through one screaming fast fire hose. And if you'd like to order historical cryptocurrency market data as CSV exports from top exchanges, then email us at sales@nomics.com.
Okay, back to our regularly scheduled program. Here's Clay's conversation with Philip Gradwell, chief economist at Chainalysis. Enjoy.
I think before we get into the blockchain and Bitcoin, in fact, I consider Bitcoin to be the blockchain. But before we get into any of this, I'd love to hear a little bit about, I guess, your origin story as an economist. How did you get interested in economics? And before you got into Bitcoin and this whole ecosystem, what kinds of questions were you asking about economics and what most piqued your curiosity?
I'm probably a slightly unconventional economist, and I guess that's why I ended up in crypto. I was doing philosophy, politics, and economics in my undergraduate, and actually I spent most of my time doing philosophy, and I didn't really get economics. It felt a bit boring and cast the world in too standard a box. But then actually I went to a lecture on the economics of climate change, and that is a big problem. How do you change the world to remove something that's so essential to it, using oil and gas, and use a different energy system? And that required challenging a lot of the assumptions about how normal economics thinks. And that caught my interest. And basically that's what I did after, my degree for, 8 or so years. And I think Bitcoin has elements of that as well. It's actually just challenging how we perceive our monetary economics. And I was like, hey, that catches my interest in the same way that the economics of climate change did, sort of a decade before.
So what were you doing at Vivid Economics prior to Chainalysis? Did this revolve around climate change and energy?
I was a economic consultant, essentially providing advice on, say you're a government or a large company or an NGO, and you're sort of saying, okay, we've got to decarbonize this energy system. That's going to be expensive. Not everyone is going to want to do it. Some people are going to win, some people are going to lose. How do you put the incentives in place so that they might be willing to go through that transition? So that was kind of really the core of the job. And it was fun. Got to work with a lot of really interesting people and travel around. But eventually I felt like doing something new.
And what might be something that is counterintuitive? So how most people think about climate change and the economic incentives that you can share with us. And is there anything in particular that comes to mind? Was there anything in particular that stuck out as being particularly counterintuitive or a narrative violation?
The way that I viewed the problem is that essentially it's an infrastructure problem. You could take a lot of behavioral measures, you could change things in your life to try and reduce the impact you might have on the environment. But you're actually going to be constrained by the building that you live in, or the car that you drive, or the packaging system of the supply chain that you get your food out of. And so that's kind of frustrating as an individual, because you're like, hey, there's not actually much I can do. It's about changing a system. And changing a system is really hard. But it meant that you had to put a lot of focus on that. So I think that, I don't want to tell people, hey, there's no personal responsibility, because actually, if you go out and buy an electric vehicle, that is helping change the system. But it's all about changing these investment decisions when people buy, a new bit of infrastructure or a new durable good. Those are where the big changes come in.
And also, whatever any individual does is probably dwarfed by several orders of magnitude by what institutions, governments, multinational corporations are doing. Let's transition then to Chainalysis. So how did you come across the team? Who did you meet first? Was it a traditional job posting that you applied for? How did you come to be Chainalysis chief economist?
I think this interest that I've always had in ways that economics can be applied in a slightly different way meant that when I read about the Silk Road on the internet, I was like, that actually sounds interesting. Not necessarily for the other reasons that people find it interesting, but I was actually like, this is almost a new business model. So like I logged in, and when you check it out, you're like, well, Bitcoin is what's making this possible. And so, whether you think that's kind of good or bad, it was a sign to me that Bitcoin was changing the game. It had sort of ripped up an old rule book and put a new one in there. So I was like, this is interesting. And that was back in 2013. And then Jonathan Levin, who is one of the co-founders of Chainalysis, he was actually an intern at the company that I was working at. And he just spent that summer talking about Bitcoin permanently. And then, which was great. Had a lot of, fun time having lunch and chatting about Bitcoin. And then fast forward a few years, and I'm looking to do something new, and I catch up with Jonathan. And, Chainalysis this is early 2017. It's starting to grow, but, things in Bitcoin, they're not quite as they're going to be by the end of the year. I'm still looking for a new challenge though. And there's this prospect of a, brand new data set. No one's looked at what's going on the blockchain from an economic perspective, really. And that was kind of the invitation, and that's what I took up.
I think what stood out to me is your analysis of Silk Road from an infrastructure perspective, right? Like you immediately latched on to Bitcoin as the infrastructure that made all of this possible. It sounds like you really sort of analyze things at the infrastructure level. That's probably one of several lenses, but one that's really important to you.
Yeah, absolutely.
What is a chief economist, at least at Chainalysis, and what does that role entail?
Chainalysis, we're best known for compliance and investigations tools and software for like cryptocurrency businesses and law enforcement. And so that is doing a lot of blockchain analysis, understanding, these addresses, they're probably controlled by the same entity, and some of these entities are sort of services like exchanges that we can name. And that is, analysis that's somewhat at like the local level. So you're trying to understand, this set of addresses, it's owned by a darknet market and it's sending some Bitcoin here. So my job as a chief economist, by contrast, is to step back or to zoom out and to try and understand the big picture. For example, we say, there's this much Bitcoin that's flowing in and out of darknet markets, but what is that as an overall percentage of the total transaction volume? And so that's the kind of question that I work out. And honestly, I've been with Chainalysis for 2.5 years now. Most of those 2.5 years have actually been on really fundamental, almost measurement questions, of going, how do I actually work out what percentage of the total transaction volume this is? Like, what is the actual transaction volume? How do we measure that? And so that's what I spent a lot of my time doing, is kind of fundamental sort of algorithms and measurement definition. And then more recently, as we solved those problems, being able to really start having a proper sort of data-driven insight into the on-chain activity.
In terms of the function you play in the org, do you sort of fulfill some kind of service role, or is it primarily kind of like a content marketing? I mean, you're not a marketer, but the job is to produce content that sort of showcases the kinds of questions that one could ask if they had access to this data set, or is it kind of both, or is it something else altogether?
Yeah, I've actually played a number of different roles while I've been at Chainalysis. So, I think we're quite well known for our blog and the content we put out there. And actually my first year was really leading that effort. And then I spent a year, we had a pretty large research team where we really were thinking how to measure things in sort of a very fundamental way. So writing, algorithms that would help us, trace various flows through the blockchain, trying to understand what's called clustering problems of when you're trying to map addresses to the entities. So that was really, sort of deep research, much more maths than marketing. And then more recently, as we've solved those problems, I do bring these insights together and use that to educate, really. I don't actually spend that much time answering specific customer requests. Maybe I should do more of that. But I think actually So the thing that's always got me, and I'm sure you have this too, there's so much money has gone into Bitcoin on the basis of so little information. And that kind of shocks me. And I'm like, well, what could happen in this space if people actually had good information to act on? And so, I've had the real privilege of trying to work out what that right information is. And now I'm spending more and more time trying to put that out in front of people.
Is there also some kind of product development role in the sense that, if you can answer this question once, maybe you can answer it multiple times at scale for a lot of customers and bake it into the product? Does that ever happen?
I really am trying to take a lot of the analysis I've done and, build it into some type of product. The insights that I'm trying to deliver are about describing how, overall activity on the Bitcoin blockchain, evolves. Whereas if you're doing compliance and investigations, that's helpful, but that's not actually your day-to-day workflow. If you're someone, say, who is making an investment in Bitcoin or is tracking the market or is thinking about making a venture capital investment in a crypto business, then you're perhaps more interested in these overall trends. And I think the challenge, which is one the blockchain analytics space, has actually grown a huge amount in the last year, and I think is trying to work out how to answer at the moment, is how do you give people specific enough insight without drowning them in data? People don't know often the metrics that they want to look at, and so they want to be able to explore, but blockchain data can be really complicated. So how do you guide them through that to the right answer? And I don't have the perfect answer for that yet. I think that's what the blockchain analytics industry is actually trying to solve at the moment.
Let's transition to chapter 1, which is based on your report. Let's discuss a little bit about what you've learned about how Bitcoin is used. What have you found about how Bitcoin is used, how it's held, about where it's going to and where it's coming from, and the number of people involved? I realize that's actually there's a lot in there. So let's just start with how it's held. What can you share about that?
There's about 18.5 million Bitcoin that have been mined to date. And I think a lot of people actually don't really understand that a lot of that Bitcoin is just sitting there. It's not actually actively used. When we see the price go up or down in the market, that's actually being moved by a relatively small amount of Bitcoin being bought and sold. And the vast majority is actually being held for investment. And we actually estimate that it's, about 60% of all the mined Bitcoin is held for investment. So this is Bitcoin that's been held often for many years, and that is also held by entities that don't tend to send much of the Bitcoin they receive. So they're really just holding on to it and sort of stocking up. So that's about 60%. There's then actually about 20% of Bitcoin that is likely lost. So this is some of Satoshi's original Bitcoin. There's potentially sort of 1 to 2 million Bitcoin that they hold. And then there's some other Bitcoin that hasn't moved for a very long time. And the week before we were recording this, someone did actually move some Bitcoin from, I think, the month after Bitcoin was created in February 2009. So that would have previously been assumed to be lost, by me, but obviously it's not. So there are always surprises there. But I think even if it's not sort of lost, it's certainly, those people are holding on to it far more tightly than most other people who are holding it for investment.
For practical purposes, what's the difference between someone who doesn't want to spend Bitcoin for 20 years and and it being lost? It's not affecting the market either way.
Yeah, exactly. And that, then leads to the sort of third major use, which is around 3.4 million Bitcoin. So it's just less than 20% that is really used in the trading activity. So if you think of the kind of float of Bitcoin that is available on all the exchanges, and often sitting off of exchanges, but ready to be moved back on, if trading, picks up, that's about, 3.4 million Bitcoin. So all of the sort of heat and light that's generated, all the noise, is actually just coming from just 20% of the Bitcoin that's been mined.
What can you tell us about kind of average holding duration? Is there an average holding duration, or what can you say about holding activity?
I think this is an important thing to say, actually. So when we think about the age of Bitcoin that's being held, we're not actually just doing it on what's called the address level, but we're actually understanding the age of, the entity, because a single person can hold as many addresses as they want. And so we've clustered them together, and there are exchanges out there that hold, millions, tens of millions of addresses. And so we're actually looking at almost the weighted average age of all the Bitcoin held in that entity. And when you do that, we see that about, I think it's 54% of all Bitcoin has been held for more than a year.
Wow. 54% of all Bitcoin has been held for more than a year. That's very impressive.
It's the digital gold narrative, really. People just like to hold it.
Without getting too much into the weeds on methodology, let's say you've got someone who has a hardware wallet. They've decided that maybe their private key has potentially been compromised, or maybe they just have a new hardware wallet and they want to transfer it, but it's still owned by that same person. Obviously, if they move it onto an exchange, that's different. But in terms of one hardware wallet to another, how do you guys see that?
That example is actually harder, almost a misconception. Like Chainalysis doesn't spend that much effort trying to understand personal wallets, because actually, they're pseudo-anonymous, so it's hard to realize kind of what's going on. But also most of our focus is on the services, because that's where the compliance workflow kind of takes you. But that aside, you can understand, even among all the addresses that are held by individuals, they will group together. So we'll see, okay, this address and this address, they're connected. And there are common ways that you can look at that. There's a thing called the co-spend heuristic, when, two unspent transaction outputs from different addresses are put together in the same transaction hash. It suggests that the private key of those two addresses is controlled by the same person. There's things like coin joins and so on that do start to confuse that. But, and there are other ways in which we can understand common control of addresses. And so in that instance, say we were able to do that as they moved from, one hardware wallet to another, then we would actually just group those two addresses together. And then that would mean that the age of those Bitcoin would actually stay the age when it came into that original wallet, rather than seeing that age kind of get reset as it moved to the new one, because those internal transfers would be removed from our calculations. And so when you look at the entity level rather than the address level, you get a more accurate picture of what's going on.
Have you found that holding activity or holding behavior is affected by price?
The way that I think about Bitcoin is there's sort of two reservoirs. There's the reservoir of Bitcoin that is, held for the longer term by the investors, and then this reservoir of Bitcoin that, is used to trade. And the key thing is when, some water sort of sloshes over from one reservoir and goes into the other. And so it's most important when, that Bitcoin, it goes from the investment reservoir into the trading reservoir, because there actually isn't that much liquidity. There isn't that much Bitcoin being traded relative to how much is being held for investment. So all of a sudden you can actually get a lot more Bitcoin being made available. Or if it's taken out of that trading reservoir and sort of goes into storage, then the amount of liquidity in the exchanges starts to shrink. And if we go, March this year, we saw really big price declines, sort of around 40% over a couple of days in mid-March. And what was interesting is that actually most of the sort of extra Bitcoin that went into exchanges outside of the normal Bitcoin that just sort of circulates around was from people who have been holding Bitcoin for less than a year, but, more than, say, 3 months. And that for me was really interesting, because that suggested people who had got into Bitcoin, say from mid 2019, maybe a little bit earlier, as things started to get almost a bit more exciting in the space, and people, potentially sort of institutionals or professionals, started to get involved. And then all of a sudden, as all the financial markets dropped, they also sold out of Bitcoin. But you can see that, they're not the long-term committed holders. They largely rode out that price volatility in mid-March, but it was actually the people who've been holding Bitcoin for that sort of medium amount of time who sold.
So within a certain individual's holdings or an institution's holdings, have you found that their use of that big Bitcoin is maybe segmented. Maybe there's a portion that's for holding, there's a portion for trading. What can you tell us about how Bitcoin holders segment their holdings and assign various purposes to them?
It's hard to get into that. Like, how does an individual, say, split up their sort of Bitcoin usage? I think the thing I'd say, though, is the overwhelming amount of Bitcoin, it's not just that it's been held for a really long time, but it's actually over 80% of Bitcoin is held by entities that have never sent more than 1/4 of the Bitcoin that they've received. So they are kind of like just a sink of Bitcoin. So this kind of conception that actually there are some people who have sort of very active wallets where they take their Bitcoin in and then they'll sell it again, or spend it on something, and then they might get a bit more Bitcoin in and then they'll sort of send it on. There's actually very few of those. That's like 20% of Bitcoin is made up of people who will be moving their Bitcoin in and out regularly. And 80% is just sitting there.
I personally don't know of another asset where, the data suggests this level of confidence and conviction. Just to reiterate what you said, over 80% of Bitcoin is held by folks that have kept more than 3/4 of the Bitcoin they've ever received. That's truly remarkable. That seems very, very bullish for the space.
I mean, I agree with you, absolutely. I do think there have sort of been waves of it. So, I think around sort of 2014, there were some people who, exited, who've been holding on for a longer time. There was sort of a big increase in the share of Bitcoin that was, younger then, because it had changed hands and it did become more liquid as well. So more people were sending a greater proportion of what they had received. So there have been waves. I do think there was some of the earliest Bitcoiners probably did sell out. But I think since then, you've seen that kind of buy and hold conviction really take root.
Do you think it's better for Bitcoin for it to be lost or for it to be hacked?
I would say it's better for Bitcoin to be lost. Like, when there's a hack, I think it just puts a lot of fear actually into people in the space. And it then means everyone kind of has to stay and keep watching, that hacked Bitcoin to see if it ever moves. Whereas, if it's lost, like, it sucks if you're the person that lost it, but at least we kind of know it's out of the supply. I mean, I guess the one saving grace if it's hacked is there is an increasingly good chance of it being recovered because there is greater cooperation amongst exchanges and, blockchain analytics gets better and you can trace it all in real time. But, I think also hackers of cryptocurrency exchanges are not always the, best people. North Korea, for example, hacks a lot of exchanges and uses that Bitcoin for their own ends. So yeah, I think it's kind of safer actually if the Bitcoin is just lost.
It's deflationary, which is, good for price movement. And then you don't have that narrative floating around. Yeah, I would agree with you. I think that makes sense. One thing in your report that I found interesting was you mentioned that 60% of available Bitcoin is held by virtual asset service providers, or VASPs. What are VASPs?
So it's a bit of, I guess, jargon that's been added into the industry through some anti-money laundering regulations. So there's the Financial Action Task Force, which is a sort of global body that advises on anti-money laundering and compliance rules for that different countries should implement. And they had to come up with a definition of sort of a cryptocurrency business, and they have called it a virtual asset service provider. Essentially, it is any service that takes custody of your Bitcoin, more or less.
Got it. So a decentralized exchange or a non-custodial exchange would not count as a VASP.
Yeah.
So 60% of available Bitcoin is held by VASP. Is that mostly exchanges, would you say?
It'll be exchanges, but also hosted wallets. It's an upper bound estimate, but the lower bound probably isn't too much less than that. And yeah, but basically between exchanges and hosted wallets, that'll be the vast majority of it.
If your assets are sitting in your Coinbase wallet or Square Cash or Cash App, something like that, all that is VASP held.
Yep, that's right.
What if you're with an institutional custodian? Would that also be considered a VASP? Yeah, it would be. Yeah. So the space, high level of conviction, but in terms of, adherence to the decentralized ethos, the data would suggest that most people, the vast majority of Bitcoin is held by people that probably do not know their own personal keys. Would you say that's accurate?
Yeah, I would say that's accurate. I think the sort of one thing here is we talked about available Bitcoin. So, I just sort of called available Bitcoin the Bitcoin that's mined, but not lost. I think it's either the Bitcoins all held by people who don't know their private keys, some because they've forgotten them, but some because they've given them up to a third party.
And I guess just going to methodology a little bit, how do you define lost? Is it no movement within some period of time?
I mean, you can identify the original Satoshi clusters, like that's important because that's 1 to 2 million Bitcoin that we assume is lost. And then you can look at the Bitcoin that hasn't moved in a very long time. And so we're not just looking at the addresses, but we're also looking at the entities, which is important because sometimes you'll have an entity that has some addresses that have got Bitcoin that have sat there for a very long period of time, but they might have an address that they send a Bitcoin from very recently. And that tells us that actually, that set of addresses is controlled by a person who's sort of still active on the blockchain. And so therefore those old Bitcoin aren't lost. So that's, an important caveat that we do sort of capture those situations. And then we also do look at this, what we call this liquidity. So do these Bitcoin send, what percentage of the Bitcoin they receive do they send? So if you end up with entities that have not moved their Bitcoin for a really, really long time and, they've stopped sending it for ages, then we think of that as lost.
Of the Bitcoin that's liquid, what do you know about, kind of the percentage of that movement being related to financial trading versus buying goods and services, a percentage of which might be illegal?
So the vast majority of the Bitcoin that's flowing on the blockchain is actually moving between exchanges. So there's 40% of all the Bitcoin that flows we know is going between exchanges within a week. And then there's around another 40% where we don't know the direct counterparties of that transaction, but we are able to say where that Bitcoin came from and where it's heading to, if it arrives at something like an exchange later. And the vast majority of that 40% that we don't know the sort of direct counterparties, we know that's heading between exchanges as well. So you're really looking at between 40 and 80% of all Bitcoin is actually just flowing between exchanges.
How do you go about tying addresses to specific financial institutions or exchanges or VASPs?
At Chainalysis, we have to have a very high level of evidence to say that this address belongs to an exchange because our customers are making compliance decisions on the basis of that, or they're making law enforcement decisions on the basis of that. So it's actually a pretty huge effort that requires a lot of human verification. So we will actually go and we will interact with these services. We'll make a deposit address. We'll send some Bitcoin to it. We'll sort of interact with the service. And that gives us, that ground truth that this service, this address belongs to this service. And then what we do is we understand the sort of network of addresses that are connected to those ones that we have identified. So there's these two stages. There's identification, saying, this address belongs to this exchange. And then there's, aggregation. So we're actually saying all of these other addresses around it, we can know that they actually belong to that exchange. So there's a combination of sort of very manual process of identification. And then there's leveraging, a lot of algorithms and logic and blockchain analysis to understand all these other addresses. Well, they're actually part of the same business.
So let's say I go to, say I have a Coinbase account, hypothetically, and I decide to generate a new wallet address to deposit funds. I send funds there. It's a net new address. How do you guys know that that's associated with Coinbase? Is it because, right after the deposit, Coinbase tends to transfer the funds from that one address to some kind of central, like more commonly used address that you guys have identified as being the recipient of all the transactions from, these ad hoc addresses generated by users? Is it something like that?
Yeah. So that is broadly the method. So a lot of exchanges, they sweep funds into a central wallet. And that is because they want to protect their customers really from the risks of hacking. So they want to keep as much of their Bitcoin in a cold wallet that is, air gapped, not connected to the internet. And they have a small amount that's, kept hot to fund, their day-to-day operations. So if you deposit Bitcoin, they actually want to get that into their cold wallet pretty fast. And so that's why they sweep Bitcoin. And through that, there are common patterns that you can see on the blockchain. But exchanges do different things. So you kind of do have to take it case by case, especially for some of the bigger services.
And what are some of the maybe more common use cases for law enforcement agencies? Like, what's a typical question that they'd attempt to answer with your data set if you can share this kind of thing?
In terms of the biggest types of criminal activity that law enforcement has had to deal with, actually in 2019, the biggest was scams. So there's a lot of Ponzi schemes out there. I think Bitcoin kind of has a problem in that a lot of people actually did get rich quick, from Bitcoin. And so if someone turns up and says, hey, come and send me some Bitcoin and I can help you get rich quick, a lot of people actually think there's some truth to that. So, unfortunately, we've seen billions of dollars flow into these scams.
Hey, I wanted to pause for a second to let you know that this episode of the Flippening Podcast is brought to you by our longtime and trusted partner, Nexo.io. As someone who personally uses Nexo, I wanted to point out a few things that I especially like about their crypto-backed loans. First, when the price of your collateral grows, so does your credit line. Let's say that you borrow against your Bitcoin when each is worth $5,000, but over the course of your loan, the price grows to $10,000 per Bitcoin. This means that the size of your credit line just doubled as well. I personally haven't seen anyone else doing this. A second thing that I really like about Nexo is that you only pay interest on the amount that you borrow. I've seen Nexo competitors require you to take out loans and force you to withdraw the entire amount. With Nexo, you get a credit line and can withdraw the funds that you need and not a cent more, paying them back whenever you want, with interest assessed daily. Again, this isn't something that I've seen any other providers do. The final aspect of Nexo I'd like to highlight is that they give you the ability to borrow against a basket of crypto assets. For example, if you post BTC, ETH, and BNB as collateral to your Nexo account, the Nexo Oracle calculates the real-time market value of those assets and adjusts your credit line accordingly. Again, to my knowledge, other providers in this space only allow you to borrow against one asset per loan. This episode is also brought to you by Uphold. As I said before, we're big fans of Uphold over here. In fact, there are several members of the Nomics team that uses Uphold. It's the only app that lets you go from anything to anything in one trade. Bitcoin to gold, no problem. Want to send euros to your sister using your XRP stash? That's easy to do. Just one trade and 2 clicks to get this done. Trade instantly between cryptos, stablecoins, national currencies, metals, and more. It's seamless, it's instant, and it's cost effective. You can fund with a debit or credit card, trade with 0% commissions, and withdraw to your bank account or external blockchain network instantly and with no additional fees. You can even send BAT to your bank account. When you have an Uphold account, you really can send anything to anything. To get started using Uphold, go to uphold.com. Again, just go to uphold.com or any app store to get started right away. Finally, this episode is brought to you by the startup that produces it, Nomics.com. Nomics is a crypto market cap website and aggregator going head-to-head with CoinMarketCap. We stand as a transparent alternative to many of these sketchy market cap websites out there. We won't name names, but I think you know who we're referring to. Anyway, if you haven't been to Nomics.com in a while, I encourage you to visit our website. We offer transparent volume statistics for nearly every cryptocurrency and crypto exchange in the space, and I believe we have the only credible crypto exchange index in the space as of this recording. If you're sick of scammy ads, bad design, and manipulated data provided by companies whose founders hide from public view, then check us out at nomics.com. Okay, let's return back to the show.
That's been the kind of biggest source of criminal activity in 2019, followed by darknet markets. So, it's people using the latest versions of the Silk Road. They keep evolving, these different darknet markets. And then law enforcement will also focus, even though these aren't always like the biggest crimes by dollar value, they're often the most serious. So there are things like tackling ransomware. So people send a virus to someone else's computer. It encrypts all their software. They can't get that unencrypted unless they pay a Bitcoin ransom. It's become increasingly sophisticated in recent years, and people are targeting, bigger and bigger institutions like hospital networks and schools and governments. And then there's, while it's small, it's very serious. So, Bitcoin, for example, last year was used in a child abuse material site called Welcome to Video. And that was actually shut down because of the or in part because of the blockchain analytics, generated some leads that, when combined with the sort of KYC information on exchanges, led people to the perpetrators. So there's a whole range of what law enforcement investigate in blockchain analytics, and it ranges from the kind of very high dollar scams to some of the more serious stuff.
I guess going a bit back to exchanges, I've got a particular interest in them. When SegWit activated, there was a huge push to get exchanges to adopt SegWit. The advocates were really pushing for exchanges to implement this, with the idea or suggestion being that a high percentage of Bitcoin flows was either between individuals and exchanges or from one exchange to another. What can you say about that? Does that seem to be sort of an informed advocacy path? What percentage of activity happening is either between an exchange and an individual, or, from one exchange to another?
I would say it's around 40 to 80% of all of the activity on the blockchain is between an exchange or an individual, or between exchanges. So it's like the vast majority of activity. That said, exchanges have been relatively slow at adopting SegWit. I think it's only in the last year that some of the more major exchanges have started to do that. So, the right advocacy path took a while for it to be effective.
At a high level, if you were to compare the Bitcoin ecosystem to a country, is there a country that you would sort of most closely pin it to in terms of sort of average, transaction volume, liquidity, GDP, that kind of thing? Is there a good analogy here, or not really?
So I don't actually think there is a great analogy. And I think that's because the Bitcoin ecosystem actually doesn't have the level of complexity yet that a real economy has. The sort of question of, well, what is the GDP of Bitcoin? It's slightly the wrong question, because there isn't that much that is, actually made using. There are not many firms that, accept Bitcoin as a payment and sell their goods for Bitcoin. And, you can do the accounting of, their profit and loss in Bitcoin. It is a lot of financial speculation. That's why I think we haven't quite got those core metrics yet for Bitcoin that would allow us to make that kind of comparator. But for me, the most solid metric that I think is comparable is looking at the dollar value that's moved over the blockchain. And, that's around sort of $14-15 billion a week at the moment. That's an upper bound estimate, because there's a lot that you need to remove. There's a lot of noise, so just transactions that are internal to exchanges and so on. We remove that, as much of that as we can. But that's a decent sized payment network if you're moving $15 billion a week between, different people.
Do you think, on-chain transaction volume is a good measure of means of exchange, or is something else better for that purpose?
That 14 billion that's moving on-chain, it's actually only maybe 2.5%, which is people actually, buying goods and services. And half of that is illicit goods and services. So it's around 1% is illicit goods and services. So that actual, exchange of Bitcoin for, goods and services is tiny. So that means of exchange use case, isn't really there yet. So I actually think most of the on-chain activity is providing liquidity for people who are using Bitcoin as a store of value.
Facebook, Twitter, social networks often come on, and TikTok, etc., and they brag about their, the number of monthly active users and things like that. Is there a corollary for Bitcoin that makes sense given how much of this is just being held? Are you a monthly active user if you're just holding it? I would argue that you are, that simply by holding it, you count, even if you haven't moved anything at all. If you were doing an earnings call for the Bitcoin network, what would you say at a very high level about active users, or just level of engagement at a high level with the network?
So I agree that you have to include these owners of Bitcoin. They may not be active moving things on the blockchain every day or every month, but they, as we've discussed, are the majority of the holders. And if you look at the number of entities that are holding Bitcoin on the blockchain, but not necessarily moving it, It's harder to estimate this because you have this problem of understanding, what's an address versus an address that should be clustered with an entity. But broadly speaking, we're looking at, millions. So less than 10 million, more than one, probably, sort of maybe 5 or 7 million people holding Bitcoin on chain. But they're not the only holders of Bitcoin, because actually the vast majority of holders are actually holding, if you like, on exchange websites. So they made a fiat wire into an exchange. They then bought some Bitcoin. And in a sense, that was the end of their Bitcoin journey. So they're just holding that Bitcoin on that exchange, or the exchange is holding it on their behalf. And that's obviously a number that we don't see on the blockchain, but it's probably in the tens of millions. So an order of magnitude larger than the number of people who actually go and, touch the blockchain. And then I think there's an interesting sort of third category of owners that are starting to emerge, which are people who are holding via trusts like, this Grayscale Bitcoin Trust, or through some of the ETPs that are out there. That's probably only in the tens of thousands, but it's an interesting new avenue for people to own Bitcoin.
Let's move on to chapter 2, which is about illicit activity. So every time a politician gets on screen or someone's, arguing against Bitcoin, it seems like frequently they're making reference to illicit activity and completely sidestepping the amount of illicit activity that happens with cash, particularly US dollars, but also euros and a variety of other paper fiat currencies. You seem like someone who really appreciates nuance and who has thought about this, at a pretty deep level. What would you say, just kind of broadly, about the characterization of Bitcoin as, a means for doing illegal things that hurt society? Is that a fair characterization, or is it much more nuanced than that?
Yeah, I mean, as you said, I will always pick up on the nuance of something. But in fact, I actually think that there's almost less nuance to this than I need to go into. So the overall level of illicit activity on Bitcoin is around 1% of the transaction volume. And that's low. Again, that is a lower bound estimate, but I spend my time analyzing all the activity on the blockchain. And in fact, that's what's amazing about the blockchain, is because we can analyze everything. We can say whether we think something's a lower bound or an upper bound, and we can say whether we think that lower bound is going to be, perhaps twice as high as it is or 10 times as high as it is. And, I don't think that around 1% estimate of transaction volume is going to be more than a couple of times higher in the sort of worst case. So actually, Bitcoin, it's definitely used for some illicit activity, and some of it's very serious. But in terms of the relative amount, it's actually really low. And we have confidence in that we don't have in any other, fiat currency or asset.
I mean, I imagine what percentage of paper fiat currency is being used to buy and sell drugs and things like that. But can you make a relative comparison? Is 1% above or below estimates of the percentage of USD used for illicit activity, or, euros, British pounds?
It is. I mean, this is genuinely we've talked to people who try and estimate this, and it is very hard. Some of the estimates are that illicit activity in, the fiat economy is, say, 5% of GDP. But that is not an apples for apples comparison, because, as I said earlier, we don't have a GDP number for Bitcoin in terms of the sort of economic value that's created by the Bitcoin economy. And if you were to look at the transaction volume in fiat, it would be a very small number, the amount of illicit activity, just because the transaction volume of fiat is so enormous, because you have things like, we have different almost types of money. So you sort of have, M1, M2, M3, and so on. And some of that is just these money market funds that move huge amounts of money overnight to finance, financial institutions. So getting the right percentage is not an easy task, and finding the right comparison is not an easy task. But I think for Bitcoin, saying if you were to get a random Bitcoin, 1 out of every 100 might have been involved in illicit activity. That is actually, I think, a helpful way to speak to, say, people who work in compliance, because they're like, okay, that's some odds I can work on.
I don't know if you're allowed to say this, but CoinJoin is pretty popular. There's Wasabi Wallet. There's Tor transactions. What do you know to be sort of the favored method for illicitly spending your Bitcoin? Is there a particular technology or wallet that sort of stands out and is kind of head and shoulders above the competition?
I don't know what is in vogue at the moment, actually. There are definitely people in Chainalysis that do, but I think I focus more on the economics than understanding that. But, I think one of the really interesting things actually is that, especially in 2019, a lot of illicit activity just went directly to exchanges rather than going through mixers and so on. And I think a lot of that was related to scam activity, where large amounts was raised in these Ponzi schemes, and then it was sent through a set of what we call rogue over-the-counter brokers. So these are people who will normally buy and sell, large amounts of Bitcoin because there isn't the liquidity on the exchange, and they appear not to have asked hard enough questions about the source of some of their funds. And they then, OTC brokers will often also then sell on an exchange because they need to manage their liquidity. And so a lot of the Bitcoin that came from these Ponzi schemes was sold to OTC brokers and then actually would end up on an exchange.
Let's transition to chapter 3, which is about exchanges. So hopefully I'm not putting you too much on the spot here, but given the data that you're seeing, who is the biggest exchange based on, what you're seeing in terms of inflows and outflows? Is it still Binance or is it someone else?
It is still Binance. But, I think, this is an interesting perspective that we have, is actually seeing how much Bitcoin comes in and out of the exchanges, on the blockchain. And that's the measure I'm kind of using here. But, so it's Binance, it's Huobi, it's Coinbase are, really the top 3. But what I also find fascinating is that the top 4 exchanges, they received 40% of all the Bitcoin that was received by exchanges in 2020. And then the next 10 received another 36%. So you've got, over 75% of all the Bitcoin coming into exchanges, coming into just 14 of them.
And do you see that becoming more concentrated or less concentrated over time?
As you had a great podcast with Nathaniel Whitmore, the history of exchanges has gone through different periods and phases.
Hi, this is Mike cutting in from the editor's booth. Philip is referring to Flippening episodes 57 and 58 titled Crypto Exchanges, a history of crypto's most powerful institutions, which we recorded with Nathaniel Whitmore. It's a deep dive covering everything from Bitcoin talk and Mt. Gox to Binance and ICO mania to the rise of crypto derivatives trading. Catch it at flippening.com/history. That's flippening.com/history. Okay, back to Philip.
I do think it's helpful to think of kind of post, January 2018 epoch for exchanges. So Binance kind of established itself. Bitcoin was coming off its, all-time high. And I think the exchange ecosystem, somewhat settled in that period of time. And in that period of time, it's been fairly constant, around 3/4 of all the Bitcoin inflows to exchanges going to the top 14. But there's definitely been some, shuffling between some of the biggest exchanges. So they change rank, but there's still kind of a core 14, 15 or so exchanges that have dominated. But there's still a very long tail because, there are hundreds of exchanges, as you well know. And actually they kind of often play a really important role in, local currency markets, for example, or in offering some kind of new and exotic way to interact with crypto.
My hypothesis is I believe that the long tail is going to get longer. Maybe not if you look at Bitcoin, but there's a lot of really interesting things happening in DeFi and the lines are getting kind of blurred. Like, is this an exchange or is this a UI on a smart contract? Or is this something completely, different altogether? Like, what is Namebase? Is that an exchange or is that a domain name registrar? Should we consider these non-fungible assets? There's CryptoKitty. There's so much that's happening here.
Yeah, and that's what's exciting about it as well.
Yeah, absolutely. Kind of the level of analysis you've done on Bitcoin. I know there's more data here, and there's probably more interest from institutions and law enforcement agencies and such. But do you have this kind of analysis available for Ethereum as well, or is there something about that chain that makes it harder to get this kind of data?
No, so all of that data exists, and one of the big things we actually work on at Chainalysis is making sure that our metrics work as well for Bitcoin as they will for Ethereum or for any other blockchain, which is not trivial because, they have different, like Bitcoin is a unspent transaction output blockchain and Ethereum is an account-based blockchain. So they have a different data structure, more or less. And so you've got to try and map that into a common schema. And then you've got to design all your metrics to operate, taking into account those differences to make sure they're comparable. I think it slows down, if you like, the process of building all these metrics. But actually then once we have it, we can run this analysis over everything. That said, the stuff I'm sharing with you is kind of so fresh that we actually haven't rolled it out across all the different cryptos yet. But, we've done it sort of experimentally, but not to kind of polish or detail that we've got for Bitcoin yet.
What have you seen about the role of fiat over time? Does there seem to be kind of more fiat interest, or I guess what I'm getting at is I've seen some interesting analysis of kind of net fiat inflows versus outflows. So let's say you bought $1,000 worth of Bitcoin back in the day when it was trading in single digits, and then, that grows. And then at some point, maybe you purchase into the Ethereum crowd sale, and obviously that takes off. And then there's the coin lottery of 2017. You buy some Dash and that goes up, and you buy something else. And so your initial investment is $1,000, but on paper, it's all worth much, much more than that, let's say in the millions. But the fiat inflows into the whole ecosystem is still just at $1,000. Have you done any analysis on kind of net fiat inflows and outflows and kind of where that sits right now?
The role of fiat in the crypto ecosystem, takes a little bit of unpacking. So, because there's a number of things kind of going on, but there's, how many sort of dollars worth of fiat actually enter the ecosystem. And I think that's a crucial number to watch, although it's very hard to observe, because that's the kind of value that's coming in to the industry. And that's really what, drives the market cap higher, is that demand. So most people will acquire their crypto because they on-ramp via fiat. And then you've got this question, okay, well, this person that you described, who put $1,000 in originally, but they have made some really big paper gains. Are they actually, as it were, that rich? And, my answer is kind of no. And the reason for that is because liquidity in crypto is still small. And so if they wanted to liquidate, a large position, they could move the market and they would no longer be as rich as they originally were on paper. And, we even debate internally when you're looking at on-chain transaction, volumes, you really need to probably think about them in what we call native asset terms, so the Bitcoin terms rather than dollar terms, because there's not actually that many dollars worth moving on the blockchain. It's only when it's being moved to an exchange and then sold that actually, crystallizes into that dollar amount. The other, to me, fascinating fact actually about the on-chain activity is when we look at the exchanges, it's actually the crypto to fiat exchanges that are dominating the on-chain flows between or into exchanges. So it's 40% of the exchange flows are actually between crypto to fiat exchanges. Another 32%, which is either to them or from them. So actually crypto to fiat exchanges are responsible for 75% of all of the Bitcoin flows between exchanges. So, the people who think actually, crypto was all about the kind of crypto to crypto casinos, it's actually about the exchanges that have big fiat on-ramps.
What do you make of Tether's quote currency dominance? Like if you would have asked me, and I'm not looking at the data, what are the biggest trading pairs? Or, what's the biggest, kind of quote currency, I would have said it, it's probably USD and like Bitcoin and Ethereum. But it turns out that Tether is just crushing everyone.
Tether is, I don't think you can really talk about Bitcoin without talking about the role of Tether. I think Tether it's particularly used on places like Binance, but also Huobi and OKX. And I think a big use case for Tether emerged, when the exchanges that were previously domiciled in mainland China had to move off in 2017. And that meant it was hard for them to get fiat on-ramps, and Tether filled that gap. I think it's a real sign, actually, of the crypto ecosystem innovating. It's like, oh, well, we need this thing. We can't get it, from the traditional world, so let's invent it. And, Tether's played a huge role in keeping the crypto market liquid and enabling those exchanges to operate. But I think there's, for me, 3 reasons why Tether has that dominance. One is, as a lot of the Chinese exchanges closed down, I think a lot of that Bitcoin that people held was actually sold for Tether. So, there are hundreds of millions, perhaps even billions of dollars of Tether, which are just held by people who essentially crystallized the gain that they had from Bitcoin when, they were forced to sell it and they weren't quite sure what to do next. And that then created this, as you said, a huge network effect, particularly in Asia, where people had sold a lot of Bitcoin for Tether. They then wanted to start trading again. And, they had these dollars to do that with. And that is related to the second reason why I think Tether is so popular. And really it's because it gives exposure to dollars, but outside of the jurisdiction of the dollar system. And, that's not necessarily to say it's good or bad. It's just there are definitely people in the world who want that. There's the Euro-dollar market that's set up in London that uses kind of fiat dollars to do exactly the same thing. That started in the 80s. People wanted to use dollars outside of the US banking system, created the City of London. Tether is doing essentially the same thing in Asia. And that's the third reason why Tether's actually, I think, been bedded in. And that's because there's actually some evidence when we look at it on chain that Tether is not just being used for trading, but actually there's a large number, an increasing number of Tether transactions for smaller, almost means of exchange amounts. It's harder to pin down the services. Anecdotally, you hear about people using Tether, as currency in China or for cross-border trade, say between Russia and China. So actually people are going, don't necessarily want a cryptocurrency, but they want, a dollar that they can transfer outside of the dollar system. And Tether fits that use case in a way that the regulated stablecoins don't.
Is there anything in particular that kind of stands out that, sort of bears highlighting from your report about exchanges that you think, merits coverage this far into this podcast?
So one I think is talking about, people discuss, is this a retail market or a professional market? And then the second is, can we actually use on-chain data to try and understand whether trading volumes are accurate, for example? So the first thing is that the vast majority of the retail market, I think, remains on exchanges' websites and rarely interacts with the blockchain. So, this is where, you're tracking these things in Nomics, and that's excellent data to try and understand that. But it's clear that even looking at things like web traffic data, the vast majority of the number of people who are interacting with Bitcoin are just logging into websites, not actually moving things on chain. But if we look at things on chain, then there's around 1 million transfers into exchanges each week. And around 3/4 of those are actually for less than $1,000, which, is sort of a retail-y kind of amount. But if you look at the value that's moved by larger value transfers, so say transfers over $10,000, they actually move over 85% of all the dollar value of Bitcoin into exchanges each week. So you've got the largest number of people are actually moving in smaller amounts, but then there's a small number of people who are actually moving most of the value into exchanges. So the way that I think about it is there's a set of, I don't know whether to call them institutions, but certainly professionals who are actually managing the liquidity across all the exchanges. And then there's this large number of retail customers who essentially are taking that liquidity and sort of buying and selling around the margin.
Whales truly can control the price, or at least collectively they can.
Yeah.
Maybe no one in particular can.
I think if you had around 10,000 Bitcoin, you can easily move the price.
Interesting. How did you arrive at that number?
The amount of Bitcoin that's going into exchanges every day at the moment is around 70,000 Bitcoin. So if you put 10,000 Bitcoin onto an exchange, you're 1/7 of everything that's going in that day. And if you do it in a very small number of hours, then, you can be basically 100% of all the Bitcoin that goes into exchanges. And if you sell it, then you're essentially going to, burn through an order book pretty fast.
What was the second point that you were making about exchanges?
As you well know, there's this big discussion around how much of the reported trade volume is actually real, versus wash trading or misreporting or, whatever other reason. And what I find fascinating when we look at the on-chain data is it gives us a bit of a benchmark, because moving Bitcoin on the blockchain, you could do that if you like, just to boost your metrics. But I don't think people
it's not free.
Yeah, exactly. It's not free. You have to have a lot of capital tied up in doing that. You have to pay the transaction fees. You have to bear the risk of moving lots of Bitcoin, which I think is probably the bigger disincentive. And so I do actually think these on-chain movements are, real. And you can take the ratio between the reported trade volume and the on-chain volume, and you can compare that across different exchanges. And that can give you a sense, not necessarily about whether the volumes are true or not, because some exchanges have very different business models, but it can help you understand what's in a reasonable range. And sometimes you'll find some exchanges that are way out of whack of the sort of standard range, or sometimes you'll see exchanges that will have a fairly sensible and constant ratio, but then there'll be a point in time when all of a sudden that ratio will essentially go haywire, and they'll start trading a lot more Bitcoin for every Bitcoin they received on chain. And for me, that's, an alarm bell goes off then. And actually, looking at this data, there was a period of time where some South Korean exchanges went through a period of inflating volumes, and there were actually legal proceedings at the back of it to confirm this. And when you look at these ratios, at that time, you can really see that happening. So that for us was nice confirmation, I think, that we can use this data to spot that type of activity. Maybe you could have spotted it anyway, but it showed that there was this disconnect between the actual amount of Bitcoin the exchange had versus how much it claimed was actually being traded.
Maybe let's transition to talking about the future of your various lines of inquiry. What kinds of questions are you most interested in getting answered in the future? Like, is it more about new questions, or is it about kind of going deeper with the boring basics and the fundamentals here? What are you most excited about when you think about maybe the 2025 version of this presentation?
So for me, the biggest thing is about getting a set of metrics that the next stage of crypto adopters will understand, because I do think the next stage will be, the sort of quote unquote institutional investors, and they are the type of people that don't make decisions without data. You go into kind of any business or boardroom and you say, hey, come and get involved in this space, invest in this. They'll say, give me some numbers so I can understand what I'm getting into. But those numbers need to be meaningful and honestly quite simple, because you've got to get people up a big learning curve. So I'm trying to move, like blockchain analytics will focus on some very technical concepts, very often. And I'm trying to move our analytics to measures that just make more sense to people, that are more natural, that connect with concepts they're already familiar with. And that actually takes a remarkable amount of, effort and time and iteration. So that's my big focus. And if I can get a set of, 5 metrics that really speak to people who make kind of big business decisions, and that helps convince them to get into cryptocurrency, then that's success for me.
Do you have collaborators in the academic world, or are there some below the radar economists that are pushing on-chain analysis forward in terms of methodologies, technologies, things like that? Who do you think, other than you and Chainalysis, who do you think in the academic world is doing interesting work that might be worth noting on the podcast?
In terms of the academic investigations of on-chain analytics, it's like, so we do quite a number of academic collaborations because we kind of want to help the academics get over the barrier of getting access to good data. And because that's genuinely one of the biggest tasks. Academics don't necessarily want to run nodes and so on, but even once they've done that, they need to structure the data. So we can help shortcut some of that. So, we have an active collaboration with City University of London and also with Oxford and with NYU. And that's actually looking more on the darknet market activity. There's, in terms of the economics, there are various groups. So UCL in London have a great team in their InfoSec group. Imperial in London also have a good group.
So in closing, Philip, I'll ask you the same question that I ask every guest now, which is this: if you could altruistically wave a magic wand and instantly make something happen for this ecosystem that brings it forward, what would you do?
I would probably give Bitcoin the social network that, Facebook has, because then, the thing that people are really excited to say about Libra is that it brings this, ready-made community of people who are already connected to each other and doing things. And if we could bring that sort of to a native cryptocurrency, I think that would be really, really exciting.
That concludes Clay's conversation with Philip Gradwell. I hope you enjoyed it. Before you go, I want to invite you to subscribe to our fully customizable daily crypto newsletter. It's the first of its kind in the industry. You choose the delivery time and cryptocurrencies. We ship tailored pricing data and market news 7 days a week. It's a great way to cut through the noise and drill down to the crypto market info that matters most to you. To subscribe, go to news.nomics.com. Again, that's news.nomics.com. All right, that's all for this week. Stay tuned for next week's episode. Until then, take care.
That's it for this week. To sign up for our free crypto investing newsletter, listen to other episodes, or get the show notes from this episode, please visit flippening.com. I also invite you to check out the startup that funds this podcast, Nomics, spelled Nomics, at nomics.com. Finally, if you got value from the show, the biggest thing you can do to help us out is to leave a 5-star review with some comments and feedback on iTunes, Stitcher, or wherever you listen to podcasts. Thanks for listening, and see you next week.